Have you ever wondered what it's like to swim in a pool of billions of dollars? Well, few of us will ever get to do that, but today, we're diving deep into the mind of a man who made it possible, a man who is considered one of the greatest investors of all time, Warren Buffett. He's the sage of Omaha, the oracle that Wall Street listens to, and today we're revealing his 3 brilliant investment strategies that you can apply to your own portfolio. Buffett didn't earn his billions overnight. It was the result of years of discipline, keen insight, and a unique investment approach that separated him from the masses. His strategies are simple yet profound. So, buckle up as we embark on a journey to understanding Buffett's approach to wealth generation and how it can transform your financial life. Let's start with strategy 1. Invest in what you understand. This principle underlines the philosophy of one of the world's most successful investors. It's a seemingly simple rule, but profound and demanding in practice. Buffett's ethos emphasizes the importance of staying within one's circle of competence. He maintains that the size of the circle isn't of paramount importance. Knowing its boundaries, however, is vital. This approach means one needs to clearly define the industries and businesses one comprehends thoroughly and feels comfortable investing in. Understanding a business inside and out means understanding how it makes its money, its position within its industry, its competitors, its growth potential, and the challenges it might face in the future. It means looking beyond numbers, stock prices, and headlines, and truly grasping how a company functions and stands in its sector. When Buffett talks about investing in what you understand, he refers to the conviction that arises from thorough knowledge. For example, when a company's stock you comprehend deeply experiences a price drop due to market volatility, instead of panicking and selling, you might see it as a buying opportunity because you understand the inherent value of the business. On the other hand, if you don't comprehend a company or its industry, it becomes near impossible to assess whether a price drop is a buying opportunity or a sinking ship. Buffett's long-standing aversion to investing in technology companies exemplifies this strategy. Despite the tech boom, Buffett refrained from investing for a long time because he believed technology was outside his circle of competence. It wasn't until he understood the sustainable competitive advantages and business model of Apple that he became one of its largest shareholders. By focusing on what you comprehend, you can navigate the turbulent waters of the market with a steadier hand. Your decisions become less about timing the market and more about time in the market, with a long-term perspective that aligns with your knowledge. You become less reactive to market volatility and more proactive in making decisions that are rooted in understanding and insight. Ultimately, invest in what you understand isn't about limiting your potential, it's about amplifying it. It's about harnessing your knowledge to make informed decisions, mitigating risk, and positioning yourself for sustainable long-term growth. It's this principle that guided Warren Buffett in becoming one of the world's most successful investors. Moving on to strategy 2. Look for companies with a moat. At the heart of this strategy is the concept of a sustainable competitive advantage. Buffett uses the metaphor of a moat around a castle to explain this. The wider and deeper the moat, the harder it is for competitors to reach the castle. In the world of investing, companies with wide economic moats are what Buffett seeks. An economic moat can come in several forms. It could be a strong brand, like Coca-Cola, that's recognized and trusted worldwide, giving it a dominant market position. It could be a patent or unique technology that others cannot replicate easily. It might be economies of scale, like Amazon's, enabling the company to provide goods and services at lower costs than competitors. The secret is that these moats should not just exist, but also endure. Buffett warns that the nature of capitalism is such that a lucrative business will draw competition, which will eat into profits. Therefore, the durability of the moat, and its ability to fend off competition and maintain superior returns over time, is key. The essence of this strategy is to protect and grow investments over the long term. Buffett doesn't just buy stocks, he invests in businesses. He's less interested in quick, speculative gains and more focused on companies that will deliver consistent growth and profitability over time. Take, for instance, Buffett's investment in See's Candies. He recognized the company's strong brand name and loyal customer base as a significant moat. Even though it seemed like he was overpaying at the time, See's Candies has yielded substantial profits over the decades, validating Buffett's moat investing strategy. Evaluating a company's moat requires in-depth research and analysis. It's not just about today's financials but about understanding where the company will stand 5, 10, or even 20 years from now. Will the company's competitive advantage endure, or will it erode over time? In essence, Buffett's moat strategy is about foresight and patience. It's about having the vision to identify companies that can stand the test of time and the patience to hold onto these investments as they compound in value over the years. This strategy requires a thorough understanding of a company and its industry, underlining once again Buffett's first rule: invest in what you understand. And finally, we arrive at strategy 3. Be fearful when others are greedy, and greedy when others are fearful. Buffett believes that the stock market is driven more by human emotions, namely fear and greed, than by underlying business fundamentals. When the markets are up, and everyone is buying, investors can become overconfident, leading to inflated asset prices. This is the time Buffett advises to be fearful, as these assets may be overvalued. On the other hand, when the market is down, and everyone is selling, investors often act out of fear, leading to undervalued assets. This is the time to be greedy and purchase high-quality stocks at bargain prices. Buffett's strategy doesn't mean being reckless or acting on whims. Instead, it's about maintaining a calm and rational approach towards investing. It's about identifying and understanding the intrinsic value of a company and recognizing when this value exceeds the current market price. An excellent example of this strategy in action was during the 2008 financial crisis. When panic hit the markets, and investors were offloading shares en masse, Buffett was steadily buying. One of his significant investments during this time was in Goldman Sachs. He invested $5 billion in the investment bank, a move that turned out to be incredibly profitable once the markets recovered. Buffett's move was based on the belief that Goldman Sachs' intrinsic value was much higher than its market price during the crisis. This decision was not made out of fear, as many other investors were acting at the time, but out of a thorough understanding of the company's value. This strategy requires discipline, patience, and a solid understanding of a company's true worth. It is about maintaining a level head when others around you are losing theirs. It encourages you to act against the herd, not out of rebellion, but out of rational judgment. Buffett's approach shows us that successful investing isn't just about understanding businesses and markets, it's about understanding human psychology. By staying calm in the face of market turmoil and capitalizing on others' fear, we can find opportunities that others overlook. In summary, this third strategy is a timeless reminder that the stock market's most significant opportunities often arise during times of fear and uncertainty. And to seize these opportunities, one must remain patient, discerning, and above all, fearless. To wrap it up, Buffett's investment strategies revolve around understanding the business, identifying companies with a competitive advantage, and capitalizing on market fear and greed. But remember, Buffett's strategies are based on long-term investment. He's not in the game for quick, short-term gains. As he once said, our favorite holding period is forever. By learning from Buffett, we see that successful investing is not just about making money, it's about understanding the rules of the game, being patient, and making rational decisions. And remember, everyone has the potential to become a successful investor. It's not about being a Wall Street whiz or having insider information, it's about sticking to fundamental principles and playing the long game. That's how Warren Buffett made his billions, and how you can grow your wealth too.